Good day, and welcome to the Canfin Homes Q1 FY2024 earnings conference call, hosted by Investec Capital Services. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nidhesh Jain from Investec Capital. Thank you, and over to you, sir.
Thank you, Dobin. Good afternoon, everyone. Welcome to the Q1 FY2024 earnings conference call of Canfin Homes Limited. To discuss the financial performance of Canfin Homes and to address your queries, we have with us Mr. Suresh Iyer, MD and CEO, Mr. Ajay Kumar Singh, Deputy MD, Mr. Apurv Agarwal, CFO, Mr. B.M. Sudhakar, Business Head, and Mr. Prashant Joshi from Canfin Homes Limited. I would now like to hand over the call to Mr. Iyer for his opening comments. Over to you, sir.
Yeah. Good afternoon, everyone, and thank you for joining the conference call today. I'll just give a brief of the highlights, a couple of points before we can open for the question-answer session. In terms of the disbursement and sanctions and disbursement, we've seen a good growth. In fact, it's been a little higher than what it was projected or it was done last year. We've had a 14% growth in disbursements, which has resulted in an 18% YOY growth in the AUM. This is very much in line with the guidance that was given of about 18 to 20% growth in AUM that we had projected. We had last time had a discussion in the last quarter that were about the lagged effect of the rate hikes on the asset side, because of which there was a slight upside available in terms of the NIM and spread. So, which has part of it has already been experienced during this quarter, as a result of which there is a improvement in spread by 16 basis points and NIM by 11 bips. The NPA also has slightly been on the higher side. There is a increase in the NPA by about 30 crores, of which around 18 crores is on account of the restructured book, which has come out. We have about 250 crores of restructured book which had come out in the months of February and March, wherein more than 3 months have elapsed, and out of that 250 crore book, we have about 18.5 crore book, which is about 8.67%, which is lower than the 10% that we were anticipating. However, it is there. The remaining 12 crores increase in NPA is on account of the seasonal effect. Normally, the Q1 there is a little bit of an increase. During the quarter, we have also, in terms of the financial accounts, we have not reversed the 17 crore management overlay that we had carried in the last quarter of last year. Although the part of the restructured book has come out of the portfolio, we have not reversed that thing. And wherever, and additionally, even in respect of the 200 crore restructured book which has come out and wherein the NPA has also been witnessed, we are still carrying the entire 67 crore plus of provisioning that was done at the time of the restructuring as per the guidelines. So these are some of the brief points about the performance of the quarter. I think now we can open for queries.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hello, sir. Congratulations. So my first question is on margins. So obviously, like you had guided, margins have done very well. But what's the outlook from here on? Also, the cost of funds that you shown in the presentation seem to have declined quarter on quarter. So what's the outlook on cost? First of all, why did it decline quarter on quarter from 7.5 to 7.3, and what's the outlook from here on?
Sure. Thank you, Mahrukh. So as we had indicated in the last fourth quarter of last year, that there was a 25 bips upside that was available. While entire amount may not come into the books, but about 5 to 10 bips could have come into the books is what we had estimated. But we have, as of now, out of the 18,000 crores, still about 5,500 crores has already experienced that rate hike that we were talking about, which has already been passed on in the Q1. And because of this, we are seeing this impact. Most of these cases were the ones where, 85 bips impact was to be passed on. And so we've already seen that. Going forward, we still have another 12,500 crore of book. But here, there is only one, on the larger component, there is only one rate hike of 35 bips which is to be passed on. So net, we might still have there, because of this 12,500 crore, we might still have on the entire book somewhere in the range of about 3 to 5 bips, which could probably go further from here. That is in terms of the, portfolio that is yet to experience the rate hike. The second point was as regards the cost of funds. So in the last quarter of last year, you would be aware that we had raised very high cost NCDs at 8.35%, because of which the cost was high. During the year, obviously, it has been spread out over the quarter. Plus, in terms of some of the banks, we've also experienced some, reduction in the rate of interest. These are the two main reasons. Plus the CP that we had raised in between during the quarter for a short period, that has also helped us. Net, if you see, the increase in the loan book has been to the tune of about 1,000 crores, whereas in terms of the borrowing, we have not added much to the borrowing. It's been much lower than that. We have tried to utilize as much as reserves and available funds are available from internal accruals. So these are the two reasons why on the cost side we have been able to bring down, or it's a little lower. And whatever little I said on the asset side.
Got it. But from here on, costs will stabilize or they'll move up?
They will not, unlikely to move up, because, the rates at which we are still getting, and we are still negotiating with banks for a slight improvement. Of course, we can't, comment on how much of it will actually materialize, but we are, trying to negotiate with the banks. And the rates have softened in terms of what we are doing. Like, for example, even the NCDs, what we are getting in the market is at a lower rate, with a sub-8. So going forward, we don't expect the rates to be on a very high side, on the cost side.
And banks are willing to negotiate on repo linked or MCLR?
Majority of our bank borrowings are linked to repo rate. So while the repo rate has not changed, what we are trying to, talk to the banks is that if we can, work on the spreads over the repo rate at which they are lending to us.
Got it. That's clear, sir. So, and what will be the, so you will keep, as you had mentioned earlier, the salary to non-salary mix would remain constant from here on, or how does it?
Well, there is no attempt to actually change it in any way. So if at all it happens, it will be by automatically whatever, because of the selection of customers. But there is no attempt or on a direction to make a change in that. We are comfortable with the present breakup.
Got it. But there's no cap on either, right? As in that, depending on customer selection, either can grow. That way?
That is correct. But the comfort or our present customer base is mainly towards salaried. So that tilt and that, even the walk-in customers, the word of mouth publicity, everything that comes in, as well as our channel with sources, is also very comfortable with that segment. So, it is likely to continue.
Got it. And so what's the progress on builder tie-up?
We have targeted that. We have not yet started getting the results, but we have made quite a bit of attempts to start the APS. A lot of files at the branches are in the pipeline where the legal processing and checking and everything is done. The benefits should start coming in from the second quarter onwards. Because by the time we rolled out the policy for APF approvals and all those things, it was already half the quarter was gone. So the efforts branches have been putting, but we have not yet seen any results as yet.
Got it, sir. Thank you so much, sir. Thanks a lot.
Thank you.
Thank you. We have the next question from the line of Dhaval from DSP. Please go ahead.
Yeah. Hi, Suresh. Thanks for the opportunity and congrats on good performance. I just had a couple of questions. First is on the restructured portfolio. If you could just give an update, what is the standard restructured book at the end of the quarter? And I think if I heard it right, you said 18.5 crore was the slippage from the restructured book into NPA. So if that is correct, what's the view on the rest of the portfolio? So that's the first question.
Yeah. Thanks, Dhaval. So the portfolio, as I clarified, we have totally about 475 crore portfolio out of the total 691 crore, which has come out of restructuring. However, there is some portfolio which has come out in April, May, and June, which have not even completed 3 months. So that is not, I think, correct to consider that portfolio. So based on the portfolio of February and March, which has come out of restructuring and where more than 3 months have elapsed, and where an account it has moved into NPA wherever 3 months has not elapsed, that portfolio is 250 crores. Out of the 250 crores, 19.5 has become an NPA, which is 8.67%. We had indicated in the last quarter that it could be up to 10%. There could be some slippage in the restructured book. So it has been lower than that. Going forward, obviously, the lessons from this are already there, so we are working on them. So going forward, at least we expect that this number could be lower also, but we would still like to retain the 10% limit on the conservative side.
Got it. And in terms of provisioning requirement, through the year, I mean, you still hold on to the credit cost guidance given at the end of last year, or any thoughts of making additional, buffer provision? I mean, I'm saying the entire FY24. Yeah.
Actually, we have already, while giving the guidance and product projection, we had already indicated that the NPA we will be considering for the working would be 0.7%, and we don't expect that to go beyond that. As regards the provisioning, you already know that we had made a provision management overlay of about 17 crore in the Q4 of last year, which we have entirely carried in this year as a management overlay without drawing up from that provisioning for the NPA which has come out of the restructured book. So whatever has moved into NPA from the restructured book, we have made additional provision as per the ECL guidelines. So that 17 crore space plus whatever addition has come, we have been able to provide from the current year profits. So that's how we have not drawn from the original provisions. So technically, we have the additional provision of 17 crore, which was the management overlay. We also have this entire 67.69 crore, which was done at the time of restructuring. So although 250 crore book has come out of restructuring and part of it has moved into NPA, we have made the additional provisioning for that additional 19.5 crores, but the 67.69 crore stays intact.
Very clear. Just last question is on the distribution. So the new branch expansion, what's the broad timeline, for the new branch addition for FY24? If you could give some perspective on that, that would be useful.
Sure. We had indicated 15 branches is what we have planned for the year. Out of that, we have carried out the survey and everything for 12, and 3 are yet to be, visited and verified and everything. Out of the 12, 4 are in an advanced stage where we have identified the property, negotiated the rent and interior work. So during this quarter, we should be able to open 4 out of the 15. The remaining 8 probably could be in the next quarter, because we are yet to finalize the rent and everything, and then the interior work will take a little while. So probably 8 more could be in the Q3.
Great. Thanks. Yeah. Sorry.
And the last 3 could be in the Q4.
Perfect. Thanks, Suresh, and wish you all the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Arvind R. from Sundaram Alternates. Please go ahead.
Hi, sir. Thank you for the opportunity. The repricing had happened this quarter also, but the yields quarter on quarter hasn't actually moved up. Any reason, why it didn't happen? And I wanted to understand little more on the bank borrowings. Is it only predominantly Canara Bank borrowings, or is it borrowing from multiple banks?
Yeah, thanks, Arvind. So the first point regarding this, why the yield has not gone up. So one of the things is that our incremental lending rates are also at a lower rate. So obviously we have a repricing and incremental rates also we give attractive rates to the customers to get the business, which is in line with this. So that's why while some of it has been, some incremental yield has come because of the repricing, some of it has been offset by the incremental business which has been done. The second point which I'd like to make is that the 30 crore additional NPA which has come, okay, that has also had an impact in terms of the non-recognition of income. So that has also pulled down some of the income. So had that NPA remained static, that income would have been higher, and this would have therefore reflected in the higher NIMs. So these are the two reasons why, the NIM, the yield is not getting reflected entirely. Your second question was regarding the bank's exposure and whether entirely it's from Canara Bank. No, in fact, the Canara Bank has a very small percentage of the total bank borrowings that we have. The total exposure of Canara for what is already given in the related party transaction details, so it's not a very large amount. In fact, the major two borrowers, the major two banks from which we borrow are SBI and HDFC, which are almost 5 to 6 times higher than what we borrow from Canara.
Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Sumit Rathi from Centrum PMS. Please go ahead.
Thank you for giving this opportunity, sir. One, I wanted to ask on the industry level, how are we seeing the growth going forward basis, given a lot of competition is coming up and looking towards housing finance and affordable housing finance?
The competition obviously is a constant. It has always been there. The pace of the competition sometimes changes. But in terms of the market, if you ask, we are witnessing a little bit of, uptick in the supply. On the supply side, at least in the medium to high level property ticket sizes, that is in the 2 BHK, 3 BHK and 4 BHK kind of properties, we are seeing some project launches coming in. So that's a good sign, and we are quite confident now that the demand is also there. The rates remaining static or remaining constant, stable. The people have also come back, and buying decisions are happening today in the market. So that's also good. And a couple of states are also looking at stamp duty and everything. So that should also push up something in terms of the demand.
Okay, so you feel enough levers for the demand is there for it?
Yeah, yes. We are confident that the demand will continue.
Okay. So I joined the call a few minutes late, so probably you would have answered it already, but I just wanted to check. What was the reason for the sequential drop in disbursement and a new approval? Is there any slowdown, or is it just a quarterly phenomenon?
No. Actually, Q4 or rather the second half of the year is always seasonally, normally 55% of the business happens in the second half. First half is a little subdued, and April month particularly is always like that. It's an industry-wide phenomena, and I think that's the only reason. There's no other reason for that. But compared to the previous year, June, you would see that there's a 14% growth in terms of the disbursements and 18% in terms of sanctions.
Correct. Great. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, hi Suresh. Congratulations on a good quarter, and thanks for taking my question. A couple of them. One is on the provisions. I just wanted to understand what's the broader thought process, right? So I mean, let's say we are carrying around.
Umang, I'm sorry. Can you be a little louder, please?
Yeah, sure. Just give me a minute. Yeah, is it better?
Yeah, this is much better. Thank you.
Yeah, sure. Sorry, so I'll just repeat. On provisioning front, I just wanted to understand. So let's say we are carrying roughly about 25 basis points of provision across management overlay and restructured loans. Now, let's say these restructured loans basically either convert into standard or NPLs through the course of the year, then basically how should we treat this 25 basis points of provision? Do we intend to carry it as a provision over and above the provisions that we have? And the second is on our stage 3 provisions, right? I mean, although during the COVID period we had kind of increased the stage 3 provisions, but it still remains significantly higher compared to what we used to have during the pre-COVID period. So on a steady state basis, how should we look at this whole provisioning dynamics?
Post this Ind AS, actually we are supposed to carry the provision as per the ECL guidelines only, and there is only one small scope wherein as a management overlay we can carry something more than the ECL. As compared to the Indian GAAP, wherein we could have carry extra provisions. So we are already carrying as per the Ind AS provision, and as a management overlay, as till this is possible. So technically speaking, once the entire book of restructured book comes out of NPA, there should not be any reason to carry the management overlay. However, we would like to, if possible, we would like to be a little conservative going forward. We'll see how it can be done, and if there is some justification, the auditors also will have to be consulted. But as of the moment, because of the restructured book, we are able to carry a management overlay. But otherwise, it has to be as per the ECL. Although as a management, we would like to carry a little more.
Understood. And if you could just help me, what is the outstanding restructured book now after 475 crore you mentioned it has already come out of restructuring, right?
Yeah, so we have 216.62 crore yet to come out of restructuring in the thing. 475 crore has come out of restructuring, 216 is yet to come out.
Okay, and that will come out of restructuring in the second quarter or post that?
No, we have up to November, August, September, October and November. We have some portfolio coming out. Although majority of it actually comes out in August. Almost 50% of it comes out in August.
Understood. My second question is on liabilities. So once again, this quarter we have seen a little bit uptick in our CP borrowings. Just want to understand what's the broader thought process. Now, I understand that in the past we have run much higher lower tenor CP borrowing book, and which had come down by the previous quarter. But as a management strategy, I mean, do we intend to kind of play tactically as far as this liability book is concerned, or we would like to cap the proportion of CPs at a particular level?
Hi, so this is Akur. So how we look at CP is as a cost leverage tool, not as a liquidity tool. So whenever there is a market opportunity wherein we can borrow from the market at a lower rate and not compromising on the ALM, then at that moment of time we'll try to avail CPs to leverage our cost. So CP as a cost management tool, cost leverage tool is just the thing. So if we look at the number of March, it was 1,350 crores, and in June it was 2,000 crores. So this is always backed up against unavailed sanction limits from the bank.
But in principle, if you are saying whether we are looking at CP as to increase the CP percentage, actually no. In fact, this year we have not even increased the limit which the board has approved for the borrowing from CP. So the overall limit which has already got the approval the year before, that continues. We have not gone for any enhancement to this thing, and it is only an opportunity where we have drawn a little from the CP, but not as a borrowing requirement. Yeah.
Understood. And just one last question is on OPEX. So 15 new branches will come in over the course of the year, and I believe in the past you have also alluded to making some investments towards upgrading our technology systems, so on and so forth. So should we assume that the cost to income ratio where we are currently will see an uptick in the coming quarters?
Absolutely. We have been mentioning that this year we can expect somewhere, last year we were 16.93 or something. We can expect somewhere in the higher 17, closer to 18% cost to income ratio. We can expect, although with the, the staggering of the branch expansion and the IT expenses, probably we don't know where we'll end, but you can expect it to be somewhere in the 17.5 to 18%.
Okay. All right, perfect. Those were my questions. Thank you so much and wish you good luck.
Thank you. Thank you.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Congrats and thank you for giving me the opportunity. My question was pertaining to the repricing. So by when would the entire book get repriced?
The entire book would come up for repricing up to December 2023.
All right.
So we have every month portfolio because we had last done it in the month of November 2022. So that will the last book would come up in December where the one tranche will be passed on.
Got it. And given that you said that there is not material increase in COF that we are anticipating. So if that is stable, then what is the sense on margin expansion? You said 3 to 5 basis point, but if it is still December, then by what how much can it still increase?
No, so we have factored in that the timing aspect also. That is why we have said up to 3 to 5 bits only is the upside that we are having. And I guess the 2.5 spread and 3.5 NIMs is what we can continue and maintain.
Okay, got it. So there was just one doubt pertaining to the yields and margin numbers. So there's slide number 10, which gives us a comparison, and then there is slide 13, which again gives us comparison. So what is the difference between the two in the names, in the yields and cost of fund?
So you said slide number 10 and slide number
13.
No, in fact, slide number 13 is more of a 5 over 5 quarters, and for the quarter specific for the as at the end of each quarter for the quarter. The incremental cost and this thing is slide number 13, and as at the end of the for the quarter is this thing. So I think this is just a subset. This is just a subset of it. We have given for 5 quarters in slide number 13, and this is only for a quarter and quarter on quarter that we have given in the other 2 slides.
So, but the numbers are different. So, for example, for June quarter, for March 23, we have given 9.87 as the yield. But if you look at in slide 13, it is 8.99. So, therefore, the disconnect. So,
No, I think I'll just have it checked. I think that is, I think that is one.
Okay, got it, sir. And the last part was with respect to the IT infra upgradation, what is the cost that we are anticipating that we'll incur for the same? Because even in the annual report, there's been a lot of emphasis on upgrading the entire infra and also having 10% coming through digital channels. So what is the OPEX that we are anticipating?
See, the board has approved a budget of 250 crores, which includes 60 crores for capex and the remaining 190 crores for OPEX, spread over 7 years. Because this project that we are, the RFP talks about a 7-year project for this. Now, the present position of the project is that we have received 2 bids from 2 SIs, and the evaluation process is going on. Now, part of the resource is also one of that is the manpower resource that they are going to provide. That is the SI is going to provide is a critical function which is also going to be part of the pricing. So once the SI is finalized, then we'll know an exact picture as to how many resources they are likely to bring, and accordingly the price. But it may not be a very large difference. To cut this thing, 60 crore is the capex, which will be 30 and 30 over this year and the year and the next year. And the OPEX will not start in this year because it will start from the year thereafter, after the 1 year, once the 1 year AMC start kicks in.
Got it, sir. Got it. So just one last question pertaining to the asset quality. So as you said that only 216 crore is now left for coming out of the restructuring bucket. But wanted to understand what is the 30 to 90 bucket, in percentage term for 1Q end versus what it was in 4Q FY23.
You're talking about which bucket? Sorry.
30 to 90 bucket.
30 to 90 bucket. I'll come back to you. We'll just do the math and come back to you. Just give us 5 minutes.
Sure. Thank you so much, sir. Thank you. And good luck for the next quarter.
Thank you. Sorry, just to come back, you are talking about the restructured book or the entire book?
Entire book, sir. Entire book.
The entire book. Okay, just a second. On the entire book, our stage 1 is around 30,000 300 crores. Stage 2, which is, SMA 1 and SMA 2, is around 1,260 crore. And in fact, the entire restructured book of 672, we have considered excluding the 19.5 crore NPA, is entirely considered under Stage 2. So 1,260 plus 672 is considered under Stage 2 for the purpose of ECL calculation, and the NPA or Stage 3 is 205 crore.
Got it, sir. Got it. And for 4Q, I'll take it from the annual reports. Thank you.
Thank you.
Thank you. The next question is from the line of Devansh Nigotia from SIMPL. Please go ahead.
Yeah, thanks for the opportunity. Sir, over the last 2-3 years, we see that the DSA dependence has gone significantly high from, I think, 30-35% to 70% here. So, since the management change, how you're looking at it, and incrementally, where do you want the DSA dependence should settle?
Well, you're right. In fact, it is more than 70%, as you mentioned. It is actually closer to 80% is the DSA dependence of the last year. And we would like to, while we would obviously continue with the DSA as a channel because it's a very important channel for sourcing, but we have also initiated efforts to source direct business, for which one of the earlier questions is also there as regards the tie-up with developers for APF projects. So we at least anticipate in the next 2 to 3 years to bring down this 80% to around 60%. So the balance should come from direct business, which is this APF plus as well as customer walk-ins. And once this IT project is implemented, we'll also be able to push for the digital sourcing, which also will start contributing once the project is implemented.
And what prevents these DSAs to actually source the customer, not to the bank, but to us, considering that the ratio is also has a salary tilt? So how does that happen?
Well, the DSAs have, first of all, they are also their comfort also comes as to how much they are able to understand and give a commitment to the customer and how much the service we are able to give. So one of the important factors is that because the DSAs have been with us for a very long time, they are also very comfortable with the kind of policy and the sanctioning and everything and what loans we are able to give. So they are also able to, kind of communicate to the customer as to whether it is possible or not. So that is one of the critical reasons that they are able to do. Whereas, sometimes, the other lenders may not be able to give that kind of comfort, or they may not be able to honor the kind of commitment which the DSAs give.
But it's highly interest sensitive. Customer satisfaction. So some soft points, if you can elaborate on which we'll be giving, but maybe other banks will not be giving. Probably they'll provide lower interest rates. So I'm still not.
Rate of interest, of course, is an important factor, but service, TAT, and of course the ability to honor the commitment, because we have decentralized sanctioning power. So our branch managers are able to commit and sanction the loans. That is one of the things. And unlike many other players who have a centralized setup and a verticalized approach, where sanctioning is so the people who are sourcing the loans are not having any say on what is the amount, the quantum, the rate of interest, the terms of sanction and everything. They are not able to commit or able to communicate to the customer. So that comfort is one of the major factors we believe, because of which the comfort is there for DSAs to bring the loans to us.
And in terms of branch expansion, any location strategy that we have with the regions that we are targeting?
Out of 15 branches, we plan to open 4 in the south, 9 in the west plus north put together, and 2 in the east.
Sure. I meant more in terms of, are they in the center of the city or outskirts or maybe tier 2, tier 3 towns?
No, we have quite a bit of urban towns which have come up, which are doing well, and where we feel we can have a good presence. So we don't have any presence. None of these 15 branches are actually in the metro towns or in the large or the mini metros. All these 15 centers that we are looking at are the upcoming towns. Most of them are urban towns only.
So just the last question. So the NCD that we have raised of 4,500 crore, what is the interest rate on that?
No, we have not raised, you're talking about we have taken an approval from in the AGM from the shareholders to raise additional. We have not raised anything during the year. This is just our provision to raise, but as and when the requirement comes, we will be raising it, and this is more to meet the regulatory requirement that 25% of the long-term borrowing has to come by way of market borrowing. So to meet that, we have taken the approval from the shareholders. This quarter, we have not raised any NCDs.
Okay. And currently, we are seeing market rates below 8% for NCDs.
Correct. For the tenure that we are looking at, we are getting quotes at below 8%. Correct.
Thanks a lot, sir, for answering my question.
Thank you.
Thank you. The next question is from the line of Onkar Gugarde from Shree Investments. Please go ahead.
Yeah, just a small question on the finance cost, which has increased significantly. Any particular reason on that front?
So finance cost quarter on quarter has not increased much.
I'm talking about year on year.
Yeah, year on year it would increase because the underlying repo rate, market, everything is 250 basis points. The repo rate has increased, on which major bank borrowings are based on. And also, capital markets from last year till right now are a little pricier, considering the repo rate increase.
If you recollect, most of the entire repo rate increase started from post June 2022. So that's where this whole thing is impacted.
So what would be the likely scenario in the upcoming quarters for the finance cost?
See, in terms of the cost, overall cost, it is kind of going to remain stable because, or we may be, obviously, though we will be trying to, bring down the rates, borrowing costs from the banks and everything. But you can say that it will remain stable because now there are no further increases expected. At least, we hope that there are no further rate hikes.
Okay, as of now, you see that it would remain stable at this rate.
Kind of, because in this quarter, of course, there has been no rate hike or anything. So therefore, whatever has been experienced is the opening cost, which was there on 31st of March, and almost on the entire liability side, we had experienced the rate hike impact in the last year itself.
Can, as far as the year and say next 2-3 years goes, you stay with your guidance of 18 to 20% disbursement and AUM growth, right?
We are quite hopeful that the markets will stay up like this and demand will continue, and we see a long runway for this for the housing finance industry. So definitely we are hopeful that we should be able to maintain that kind of a growth, unless there is something very, very untoward, which we hope not.
Okay. Another small thing is on the fundraising which you wanted to do. Any timeline on that front? Equity fundraising.
No, it is again more of an enabling provision. As of now, we have a ROA of around 2.1, or in fact 2.19. So even assuming 2 and a gearing of around 8 times, we should be about 18% kind of a growth should be manageable from internal accruals. Of course, if the rate picks up and there's a good opportunity, then we will look at it. So as of now, we've not got any timeline, but it's more of an enabling provision.
So you are comfortable with the gearing of around 8, right? Not beyond that.
Kind of, yes. Right now, up to 8, I believe there is not much of an issue. We should be comfortable.
Okay. All right. Thank you very much.
Thank you.
Thank you. The next question is from the line of Ratik Gupta from Guardian Asset Management. Please go ahead.
Yeah. Good afternoon, sir. So the PCR ratio seems to be declining for this quarter. So what sort of future PCR are we looking at?
Thank you for this. See, as I explained earlier to one of the other queries also, that the requirement for provisioning is purely as per the ECL guidelines now. So whatever provision or the PCR of 46% that we have shown is purely based on the provision maintained as per the ECL guidelines. However, it does not include the 17 crore management overlay that we are carrying and the additional 67 crore that we are carrying for the restructured book. So if we include that, definitely it will be higher. And as indicated earlier also during this con call, that If possible, and if the auditors are also comfortable, we as management would definitely like to carry a little higher than the ECL provisions.
Okay. And sir, previously we used to receive an outlook of what the loan book growth can be in the coming for this year and for next year. So what sort of growth are you looking right now?
We have indicated that we'll be looking at around 18 to 20% AUM growth is what we are projecting.
Okay. And based on disbursement, am I right to say that 3% of the book gets closed every quarter?
That is right. You're right. 3% per quarter you said, right?
Yeah.
Yeah, that is fine. That is correct.
Okay. Thank you.
Thank you. The next question is from the line of Prakriti Banka from HSBC Mutual Fund. Please go ahead.
Yeah, hi, good afternoon. Just two questions. I joined a little late, so I missed it in case you spoke about it earlier. So the yield improvement in this quarter has been much more than, what we had spoken of how about a part of our book is going to get repriced by 85 bits, so we might have about 14 bits. So what is the yield trajectory from here? And the second question is on the average ticket size. The incremental ticket size you mentioned in home loans is 22 lakhs. Is that correct?
Yes, that is correct. Yeah, thanks, Prakriti. So, first point on answering to your first question.
Yield. On yields.
On your first question, the yield that we are talking about, we have got a sequential growth of 16 bips in spread and 11 bips in the NIM. We had, if you recollect, indicated that, the restructured book is going to come out. 18,000 crore was there at the beginning of the book, which was yet to experience the part of the rate hike, of which we have already experienced it in about 5,500 crore approximately of about 85 bips. That is the reason why this has gone up. And this has also been supported by the fact that, when we began the year, we had expected the cost to remain stable, but on the cost side also, we have been able to slightly negotiate with a couple of banks and have been able to bring down the borrowing cost. Going forward, we still have about 12,500 crore of book, which is yet to experience some of it, but a large part of it is yet to experience a lower spread of 35 bips only. So overall, we expect another about 3 to 5 bips, which is possible going from here, where we could see the benefit coming from the rate hike, which is yet to be passed on.
Okay, got it. And so on my calculated numbers, I'm getting a yield increase of, almost of over 30 bips, but on your numbers, it's not that, right? You're still at about 15, 16 bips only in this quarter?
I'm sorry, I didn't get you. 30 bips of what?
No. So the quarter-on-quarter basis expansion in yields for you comes up to what quantum? Yield, not the spread.
No, the yield is around 9.84 is what is the yield on the portfolio. I think that also we answered earlier, that 9.87 which was there. There are two reasons why that is not getting reflected in the yield going up. One is because, while the yield has come on the 5,500 crore of book, we've also been on the incremental lending. We've also had some offers and all that. The incremental lending rate is also slightly on the lower side. That is part one. Okay. And part two, which is that we have additional increase in the NP of about 30 crores. And therefore, there is a non-recognition of income on that additional 30 crores, which is also one of the reasons why the yield has slightly been pulled down. Got it. Understood. Yeah, and coming to your answer, sorry, we missed out on that 22 lakhs. You're correct. The average ticket size for the quarter in home loans is 22 lakhs as compared to 24 of last year. But that is more because, some large value things were stopped in the city of Bangalore and all and Karnataka because of the change in the sub-registrar offices and digitization that was going on in some of the locations. So some high-value loans we have had to have impacted in the disbursement also. So another 80 to 100 crores of disbursement also has probably been impacted because the sub-registrar offices were not taking the LSRs and all those things were getting impacted.
Okay. Otherwise, the idea of increasing our average ticket size, that continues to stay.
That continues. But again, as I think you might have missed this answer also, we did mention in the beginning that this APF that we are talking about and this builder tie-ups, that was incidentally the first question, that where we said that we have that intent to start that, and we have started the efforts. But by the time we rolled out the policy and everything, it was almost half the quarter gone. So the impact is yet to be witnessed. Once that comes in, is when we will start seeing the business coming from the APF and the projects and the 25 to 1 crore kind of a segment.
Got it. All right. Thanks so much for answering my question. Thanks.
Thank you. The next question is from the line of Harshvardhan Agrawal from Bandhan Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. So just wanted to understand the stage 2 numbers that you mentioned. Because if I were to look at some transcripts of previous year, we were hovering at around 1,000 crores, maybe 1,100 crores of stage 2 number. And the numbers that you mentioned now is at somewhere around 1,900 crores. So there's a sharp increase in stage 2 numbers in the last 1 year. So how should one look at it? Is there some incipient stress that we're looking at?
No, I'll just clarify. Our stage 2 numbers are around 1,260 crores only. I said that additionally, the entire restructured book we are considering under stage 2, although they are under stage 1 or regular, or they have not even come out of the restructuring. So as we are taking the entire thing and making the higher provision. For the ECL purpose, the entire restructured book has been pooled along with the stage 2 assets for the purpose of provisioning, not that they are in stage 2.
No, I agree, sir, but even in the previous on calls, we had the same policy. So earlier when we had the 1,000 crore rough number, even that included the restructuring book. And even today, including the restructuring book, it's around 2,000 crores. So I just wanted to understand.
No. I'll just clarify. Even in the month of March, what stage 2 we had, that is SMA 1 and SMA 2, was almost in the same line. In fact, there is a little 100 crore which is an increase. So probably, the 1,100 crore that you're talking about might be the same, because we have overall our delinquent portfolio has come down by about 150 crores, but stage 1, stage 2 has slightly increased by 100 crores, which is what is coming up as 1,100 to 1,200 crores.
Sure. That is great. Thanks.
Thank you. The next question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity, and congratulations on good set of numbers. So a couple of questions. The first one being, I just wanted to understand the math behind, setting aside the seasonality on the disbursements. Repayments have remained steady quarter on quarter. So in light of 18% growth, how do you see this math panning out going ahead?
Sorry, can you just repeat it, because you're slightly,
Yeah, I'll be louder. So repayments have remained steady on sequential basis. Disbursement, you said there was slightly, due to seasonality, there was slight sluggishness. So we are guiding 18% growth. So how do you see the math panning out in terms of repayments versus disbursements in order to put up that 18% plus kind of growth ahead?
Well, if the disbursements, you're right, the disbursements, which is about 14%, should pick up in the coming quarters. So, with that, we should be able to, probably we are now at the 18%, it could slightly go up. But again, as we move forward, the pressure on the prepayments could also come up. So I think it is fair to keep the target at 18 to 20% only, because in this quarter we have not actually seen any pressure on prepayments. Hopefully, if that remains, this might pick up, but normally in the second half, the prepayment pressure also starts coming in when the competition also starts offering very attractive rates and special schemes for BT and all those kind of things.
Right, so that helps. And so secondly, you mentioned you're comfortable at 8x kind of leverage, but then if I just extrapolate, going by your risk-weighted assets number taken from the annual report, so is it that, it becomes imminent for capital raising in FY25?
Well, as I said, it's 8 times gearing and 2 ROA. 18% is there, but if we consistently keep doing it, probably we may require, yes.
Yeah, correct.
Normally the this thing only comes in the Q1 when but once the AGM happens and the accounts are approved, then in that case normally the borrowing does go up. So that time it's normally not much of an issue thereafter.
Noted. So just two bookkeeping set of questions. One is, if you could provide the quantum of borrowings for the quarter gone by, and also what is your rack rate in the loan?
Sorry, what is the second question? First was the borrowing. Second is?
What is your interest rate, rack rate, lending rate?
Rack rate. Okay.
So during the quarter, we have experienced a loan book growth of roughly 950 crores. And we have, on the bank borrowing side, we have experienced a net incremental borrowing of roughly around 700 crores.
And our lending rate starts from 9.6 onwards.
Okay. Sure. Thank you.
Yeah. Thank you. The next question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, Suresh. Hi, Purv. Thanks for the opportunity. Two questions. The first one is, if we can decompose the growth guidance that we are giving, 18 to 20% would have some ticket size inflation in it, which would be around 4-5%, some amount of efficiency in it. Branches would be maturing. So what is the pure growth number, pure new business number in that 18 to 20% growth that we're guiding for? That's the first. Second is, how do we split our OPEX into cost of collections and cost of acquisitions? And if we can further split the cost of acquisitions in our South territory, which is our home territory, and non-South territories where we want to expand our book. Thanks.
Yeah. The first question, Shubhranshu, I'll just answer your first question. The calculation of 18 to 20% is based on a 20% growth in the disbursement. Last year we had done about 9,000 crores. So around 10,500 crores or thereabouts should get us, considering the present prepayment ratios and all, should get us somewhere around 6,500 crores of net accretion to the book. That will be around 18 to 20%. So that's the basic math. Now to the question as to where this 20% growth will come from. So we have a branch expansion, about 15 branches planned for the year. That should bring us, but that should not be a very large number because we have it staggered over the period, and the first year the branches don't contribute very large numbers. But the majority of it should come, one, from the increase in ticket size because of the normal inflationary increase that happens in the cost of construction and all, which should be around 3 to 4%. And additionally, we are looking at an increase in terms of the ticket size, which should also help us in bringing this because, we are targeting this approved project files, APF, and that should help us slightly increase our ticket size once we move into the 25 to 1 crore segment, which is predominantly the segment where this APF happens. So this is the main reason.
Right. So, essentially 18 to 20% roughly, you think 7 to 8% should come out of ticket size impact, right?
Kind of, yes.
And what would come out of branch efficiency?
Obviously, we expect another 10% of all branches to do definitely more than what they're doing. So at least 10 to 15% of branches is what we have increased for the budget for them, and another 5% should come from the ticket size and from the branch expansion.
Okay, and the OPEX part that I had asked.
See, the major, we have 80% of the. I'll answer to the second part of your cost part of it as to what is the acquisition cost. So we have 80% of the loans being sourced through the DSA channel, where we are paying a graded structure, and about 0.43 of is what is the payout, which is effective payout that is going out to the DSA channel on that 80% of the loans which are being sourced through the DSA channel. That's the only other, acquisition cost because we don't have any other channel. We are not much into, this. But a little bit of, business development expenses could come this year, but because of this APF penetration that we are looking at.
Right. And cost of collection?
Cost of collection, actually there is no additional cost of collection except for whatever, because it's our own staff that is doing the collections also. We don't have a dedicated separate team or anything which is doing it. So in terms of that, I wouldn't say there is much of it, and nothing that I can attribute separately to it.
Right. And if I could just squeeze in one data keeping question, what is the total borrowing number of this quarter?
29,700.
Right. Thank you. Thanks, Suresh. Thanks, Apur.
Thank you.
Thank you. We have the next question from the line of Pawan Kumar from Ratnatraya. Please go ahead.
What would be the BTO for this quarter, and what?
Sorry to interrupt, sir, but the line for you is very low in volume. If you could please speak closer to the mic.
What would be the BT outs for the quarter, and what should be the normalized BT out ratio for the year?
The BT out during the quarter is not a very high number. Our normal prepayments is about ranging between 100 to 125 crores per month. So that's about 400 crores. I think max we would have, not even that much, about 350 crores is what we would have had a prepayment, of which BT out would probably about 100, 125 crores, not more than that.
125 crores per month?
For the quarter.
For the quarter. Okay.
Yeah.
Okay. And sir, another thing, on the restructured book which has come out of 470 odd crores that you are talking about, so how do we actually define that they have come out? In the sense, is it like the payment due has already started? And are there any further more GNPAs expected from the same 470 crore pool going forward? Because my understanding is there would be maybe, how many have actually paid one or more installments?
Sure. So how we consider them to be out of restructuring is that whenever the restructuring was given, there was a tenure of fixed tenure for which the restructuring was given. And once the period comes out, the EMI demand, or rather the demand starts. That is when we say they have come out of restructuring. Okay? And as of now, while 475 crore has come out of restructuring, as I had earlier mentioned, only about 250 crore is the portfolio wherein more than 3 EMIs have become due. And from that, if you look at it, only about 19.5 crore has turned into NPA. So the balance portfolio is where at least customers are paying something. That's the thing. And now to the remaining part, whether there will be some more NPAs that could come out of 475, yes, because 475 minus 250, around 225 crore, are such cases where even 3 EMIs have not become due. So some of the customers, if they don't continue to pay, and then they could move into NPA. Plus there is a 216 crore of portfolio which is yet to come out of restructuring. Overall, we have given a guidance that up to 10% could go into default, wherein we may have to carry a provision. Although the present out of 250 crores, it is only 19.5, which is 8.67%.
Okay, but this 250 crores, since they have not paid their 3 EMIs, then it should technically be a GNPA, right?
We have classified 19.5 crore as a gross NPA, and for the rest of the book out of 250, there have been cases where people have paid out of it. So there have been people who are absolutely regular, and some of them are in SMA 1, 2 or SMA 0.
Okay, and apart from this 250 crores, out of the 470 crores, you are saying they are paying very regularly?
There are cases which are paying also. I didn't say all of them are paying. As I said, 475 has come out of restructured book, of which 250 is where more than 3 EMIs are due, and 19.5 has become NPA.
Okay.
No, the NPA is not 250 crore. I'm sure. 250 crore is the portfolio which has crossed 3, where more than 3 EMIs are due. But only 19.5 is such where the customers have not paid 3 EMIs and are therefore NPA. The remaining ones have paid the EMIs, part of it or full.
Okay, but if 3 EMIs are crossed, then it is 90 days plus due, right?
Yeah, that's right. So they have been more than NPA, no? That's why 19.5 crore is such where they have not paid. So if they have paid, say one out of the two EMIs, they would be in SMA 0. If they have paid 2 out of 3, then also they will be in SMA 0. So that's how the classification. I'm saying only 19.5 crores are there where more than 90 days EMIs, more than 3 or more EMIs have not been received, and that is the portfolio which is classified as NPA out of the 250. The remaining 231 crore is such where they are paying.
Okay.
Okay. To clarify, if you're taking it that way, so 250 crores worth is the portfolio who has become regular out of the restructured book. It is not that they are not paying. So.
Okay. Okay, that's fine. Fine, sir. Thank you.
Thank you. We have the next question from the line of Anusha Raheja from Dalal & Broacha. Please go ahead.
Yeah, thanks for taking my question. Am I audible?
Yes, you are audible.
Yeah. So what will be your full year credit cost guidance?
No, credit cost, we are talking about 10 bits only. We have so far not seen anything. We may have to carry some provision for the NPA, but in terms of absolute write-off and credit cost in that sense, where we will not be able to recover, that will be not more than 10 bits.
So that will, the total hit on the PNL will be closer to around 10 bits. That will include on the restructured provisioning as well, right?
No. You're talking about credit cost in the time of losses, or you're talking about NPA provision also?
NPA provisioning.
We are saying 0.7% up to 0.7 could be the portfolio which could be under NPA. Consider including the portfolio which will come out of the restructuring. So 0.7 is the portfolio which will be NPA. The actual provisioning of that would be 0.4 to 0.46% is the ECL guidelines that we are doing, or 0.5 you can say. So that would be the provisioning that we will have to carry on that book. And but the actual credit cost in terms of the write-offs, in terms of the amount we will not be able to recover from the customers, it will not be more than 10 bits.
Okay. And I just actually missed on to your builder loan strategy. If you can just elaborate a little bit more on that.
So this year, with a view to improve our direct sourcing, we would like to, we have identified the APF, that is the approved project file concept for tie-up with builders for sourcing of direct business. There we have already initiated efforts, and we have already, marketing with the builders for sourcing the projects. Thus far, we have not received any approvals because we have started it only in the last month and a half or two. So we are expecting that to happen, and once that happens, mainly we are targeting the segment of 2 BHK, 3 BHK properties in the geographies that we operate in smaller projects, not the very, very large projects, because the smaller projects are easier to handle. Basically, this will be the category B and category C developers. So with the Cat B, Cat C category of developers, we would like to tie up for the project sizes where the unit costs are in the 25 lakh to 1 crore segment. And in that, we would like to tie up with them for and give the legal clearances so that we can do direct sourcing of business from there.
Okay. And what is the average ticket size of the home loans currently?
For home loans, it is 22 lakhs in this quarter and 8 lakhs for the NHL.
Okay. And incrementally, you're saying that closer to around 5% or growth in the AUM can come from increase in the ticket size. That will, this 22 can become 25 odd, right? I mean,
we are projecting it to slightly be in the 25 to 27 lakh range.
27 to 28? 25
to 27 lakh range. Because we are right now at 22, it has to inch up. Last year also we were around 24. So once we start doing this APF project, we expect an average ticket size of around 40 lakhs in the APF from the APF projects, because they are, as I said, they would be the 25 lakhs to 1 crore segment. So an average ticket size of around 40 lakhs is what we can expect from there. This would help, even if we get 10% business from this segment in the year, we should be able to increase it from the present 22-24 to around 27.
Okay. But then upwards of 30 lakhs, if you will see, I think even banks are quite active in that segment, right?
So when you say that you will be having 80 to 20% sort of growth, over a longer period of time, and incremental, some part of the growth is also coming from the higher ticket size. So, so how do we see that? Because that will, also call for shrinkage in the margins as well, right?
There could be some impact on the margin, but basically, as I said, we are looking at the Cat B, Cat C developers and the smaller projects, where the project size is. So there we should be able to at least make some inroads and get some business.
Okay, and what could be, how can we look at this as builder sourcing sort of loans over the period of next, say 1 or 2 years? What could be its share in the total, the loan book pie?
This APF that we are talking about, we expect going forward to contribute somewhere around 20% of the business. Because right now, as we mentioned, 80% of the business is sourced through DSA. So we expect that to come down to around 60% in the next 2 to 3 years. And we would like to bring about, the APF should contribute about 20%, our direct business another 10%, and about 10% should come from the digital sourcing that we would be able to start once our systems are in place.
Okay, and how much could be the benefit, in this, because versus, how much you pay out to DSAs currently?
See, we are paying out up to 0.43, that is 43 bips for to the DSAs for the business sourced by them. So that obviously will, if we get the direct business, that will be a saving which we can use to pass on to the customers in terms of this thing.
So, you broadly, we can expect the return ratios in terms of ROA and ROE to maintain, at the current levels, despite the fact that there will be increase in the ticket size. So that's a fair assumption?
That is a fair assumption. 2 to 2.1 ROA and around 17 to 18% ROE.
Okay. Okay, thanks.
Thank you. We will take that as our last question for today. I would now like to hand the conference over to Mr. Suresh Iyer for closing comments. Over to you, sir.
Yeah, thank you. I would like to thank all of you for taking your time out for this Q&A session and for this presentation. If there are any queries, you can always most welcome to reach out to us. But I hope we have answered all the queries. And if there is anything missed out, you can please get in touch with us.
Thank you.
Yeah, thank you, Nilesh.
On behalf of Investec Capital Services, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Thank you.